And Joan Trant, who is my first victim, she's the managing partner of TriLink Global, which she'll tell you a little bit about when she starts talking, when I finally let go of the mic. But I wanted you, if possible, to just explain to us what the E and the S and the G in ESG are, so that we've just got a really clear understanding of that. So, take it away.
Well, good afternoon, everyone. First of all, perhaps by a show of hands, can people say if they are familiar or not with environmental, social, and governance? Okay, we see several hands. This is exciting. Okay, so very quickly.
Fact check.
Yes, okay, good. Don't catch me out. So environmental social governance is an approach by which you consider your investments not only by strict financial criteria, but also by criteria that may appear to be non-material, but that can have very material, very financial effects as you do diligence investments. So this came out of a trend in investing, which began with the SRI movement, the socially responsible investment movement. You're probably very familiar with it because it really took center stage with the divestment movement in apartheid South Africa. So everyone's familiar with that, I guess. I don't have to go into it. It's largely negative screens. You will not invest in companies that do not adhere to your values. That began to feel like, okay, we're excluding a lot of companies, and therefore we can't influence them. If we're shareholders, we can influence them. So then the movement became, let us hold some shares, and that gives us a seat at the table to try to drive the change we seek in management and in practices. That positive screening turned into, well, let's think about what do we really want to see in terms of policies and procedures in companies. So the E for environment means that at the bare minimum, the company is adhering to local environmental standards. Ideally, they are adhering to international standards. If those are in fact higher, they aren't always. They may also be referencing if they have wastewater treatment, renewable energy, other conservation activities. The S, social, stands for how is the company engaging with its stakeholders. So essentially, how does it treat its employees? Does it have maternity, paternity leave training programs, fair hiring, recruitment, redress process? How does it interact with its other stakeholders, like its consumers, the communities where it operates, etc.? The G for governance, and people in this business very often say it's really all about the G, because without the G you don't have the E and the S either. Governance is essentially, how is that senior management team operating the company, and what are the controls on the senior management team to make sure that they are truly doing the right thing? So we look at all kinds of things like, are there independent audited financial statements, reporting, whistleblowing procedures, who is the board, who are the advisors, if there's too much groupthink because everybody's a crony. Those are the type of things that we will look at in governance issues. So ideally, we will be talking about that in the panel. I'm just going to throw one more further evolution in the process, which was, well, this is great. We can see a lot of companies that have great policies and procedures on the books, but what if they're not walking the walk? So that brought us to the next stage of impact investing, which is going beyond intention to actually understanding what are companies doing that contribute to good social, economic, and environmental outcomes. So we can talk about impact investing if we have time later.
Thank you. So, you're talking about how companies run their business, whether it's the environmental impact they focus on, that they have an awareness of their social impact, and that they're well governed. I mean, this just sounds like basic risk management to me. Like, how does this differ from a straightforward due diligence process if you're looking at ESG as a specific measure for a company's fitness for investment?
That's exactly our point at TriLink Global, which is you really need to take these factors into account. It is just better risk management. And while people used to think that this was nice and fuzzy and could actually, though, cost you some money, so why do it? The truth is quite the opposite. We have an extensive and growing body of research that goes back to the 1970s when SRI started and picked up on ESG that proves that there is the potential for comparable returns, so you do not take a haircut on your return with lower volatility. And in fact, MSCI just came out with a report not too long ago where they took their MSCI World Index and they have an MSCI World Governance Quality Index, and remember we talked about it all goes back to G. Their Governance Quality Index outperformed its world index in performance, financial return, by 190 basis points from a period that went from December of 1997 through June of 2015. What was interesting was they also saw a 130 basis point reduction in risk. So if you think that this is just kind of nice fluffy stuff that you'll do in your spare time, you're really missing the boat, because you will find better companies that will give you better risk return profiles that will keep you out of trouble with the next environmental disaster or Foxconn or whatever the crisis or scandal du jour turns out to be. It will protect your portfolio, it will protect your investors.
Thank you. So I'm actually going to introduce an acronym counter, because you're only allowed 3 each. So you just use ESG, SRI, what was the other one? So there's going to be a limit on that. MSCI. So Roberta and Anne, you're involved in so many things that it would take the rest of the panel to explain it. So I'm just going to say that you're the managing partner of Roberta and Anne Capital Partners, because that's easy for me to remember. So tell us about your experience with ESG. Like, when did this first become a thing for you?
Thank you. Thank you so much, Dan, and that was a really great introduction. So my name is Roberta and I am Ghanaian, and back to your question about when did this begin for me. Well, my background actually, I worked with the United Nations, so I think this whole concept of ESG has been part of my journey since the very beginning. I'm sure many of you here, especially being alongside UN Week, you are aware of the Millennium Development Goals that the UN set several years ago and now has graduated to the Sustainable Development Goals. So what I was doing at the UN, I was raising money for projects that needed extra funding from family foundations and endowments and some CSR budgets from different companies. And and obviously, like the UN standards, they go according to the Millennium Development Goals. So they had about 8 goals that just went from gender equality all the way to the environment and looking at strategic partnerships. And now they have the SDGs. So another acronym. So basically, when I left the UN, I started my boutique consulting company, and I was doing exactly what I was doing at the UN, which is raising money for projects, but really with a strong focus in Africa. And that really kind of took me into the family office world. And a lot of family offices have been doing philanthropy and now also interested in like the whole impact investment concept. But ESG is very, very integral to the criteria that they look at when they're looking at companies that they want to invest in. And even on the level of their companies, they also make sure that they have standards. So I think ESG is just a different acronym or a different application of what I've already been used to, whether it's through my experience at the UN and now with what I'm doing for family offices.
So it's really a sort of formalization or encapsulation of something that's been going on for a long time. Okay, great. So I'm sort of sound like I'm rushing a bit, and I am actually rushing because I want to get a lot in. These guys have got a lot to talk about, and I know that you guys have probably got places to go and people to see.
Lots of questions.
And lots of questions as well, so we're trying to pack a lot in here. Michael Hall is the ESG manager at Development Partners International, so he's actually got ESG in his title, which means he's qualified to explain all of this to us, hopefully. Otherwise he's in the wrong job. But so in practical terms, can you just give us a quick rundown on how you actually perform your role?
Yeah, no problem. So as everyone's spoken about, they've given a good overview of what's involved, and my job's actually to implement that in the funds, in DPI's funds. So from everything from the starting point of screening out businesses that don't fit with our ESG sort of standards for the company, through to doing the detailed due diligence for every company that we invest in. That's actually a job requirement. I have to go and visit each of our companies, and then I have to compile a report that then goes to our investment committee that we then have to sit on and argue about. And then I'm also responsible for monitoring the application of our standards and the objectives that we've given to each of our portfolio companies through the life of the investment. So it's basically trying to identify the risks before we invest. With the risks we have identified, make a plan for how we address them, and then what goals we're going to give to each of those companies, and then making sure they do it by the time we exit, so that we can get the highest return for the business.
So do you actually have like a clipboard of certain things that you need to absolutely tick off, and then optional things? Like, how does that work?
Yeah, so clipboard's a really good way to get everyone sees. Every time I go to site, they always say I'm walking around with a clipboard and a notebook. That's exactly what I'm doing. It's not necessarily a clipboard. I think we have compiled a set of standards for our company that are based on a number of different sort of global initiatives. The best way to look at that is that we've used the World Bank standards for our risk, the risk element of the business. We use another set of governance standards to look at what we think our ideal board structure would be, and what the governance system should be for each of those businesses. Those are like the base non-negotiables. What we develop an action plan for each of our companies in order to meet those absolute things. The good to haves, and I don't want to call them good to haves because we also include them in an action plan, and each action plan goes into the shareholder agreement. So I make sure that that's a sort of also a non-negotiable thing, because a lot of our investments are minority shareholding. So I want to make the case that even in a minority situation, you can affect huge change in this arena by making sense. If you communicate with your portfolio companies and give them, enough reason to believe you that this is going to be the right thing to do, they will do it. So the next level is then we look at the sustainable development goals, and so what actually can these companies, not by changing anything that they're doing, not by changing their business structure, by enhancing certain things that they're doing, where can we create greater development impact? And that's something that we've always tried to do, but it's becoming more and more appreciated, I think, now, given the global goals are getting such a strong sort of response. So it looks really good to be able to say where we're contributing to the SDG, the Sustainable Development Goals.
It's all right, once someone's used that acronym, it's
fine, I can do it.
Keep using it. That's actually just an aside on the Sustainable Development Goals. I'm hearing a lot about that, like conversations I'm having with impact investors, with, in this discussion with people that aren't even really focused on that, the sort of nice, warm and fuzzy side of investing. Suddenly, I'm hearing a lot more about the SDGs, and it feels like that's very transformative. I didn't hear nearly as much about the Millennium Development Goals, and you never really heard serious investors talking about United Nations in a kind of positive way. So that, I don't know whether you've had that experience, but suddenly you've got this sort of very recognizable set of goals that leads to a very recognizable set of standards.
I think that this is a learning experience I think this is a learning experience from the sustainability world. I work with a lot of people that do a lot of, sustainability communications work, where they're producing reports for companies and they're telling their sustainability story. I look in drains. I go to companies and I try and figure out what's, where we can change employee contracts, and there's the really gritty end. It's not cool. It's not, and it's not glamorous work. And one of the things that we've always really struggled, I think, as a group of people, is how to take what we do, which is super important. Human rights is super important, but the day-to-day of ensuring that human rights are, you're not having human rights issues, the day-to-day of doing that's not very glamorous. I think what they've learned and what we've all learned is now we needed to get behind a set of goals that actually everyone could understand. And again, the second level of the SDGs is again really boring. Getting those things in place takes a lot of hard work, but they've put a lot more effort into creating something that all people can sort of get behind and understand.
Yeah, well, and I think it's also companies seem to be amenable to kind of adopting these goals, which I've just never seen before. So, Roberta.
I actually wanted to also refer back to this an entity at the UN called the Global Compact, and I think private equity funds and companies can actually join the Global Compact if they can, kind of pledge that they will meet at least certain levels, of the SDGs. But I wanted to come back to the Africa context, if that's okay, because I recently researched a report that Africa puts out. I think it's the Africa Sustainability Report, 2017, and they gave an example of, so basically they did like, the survey on mini companies, and it looks as if most of the PE funds that are going into Africa have some sort of ESG standards, and I think this is what a lot of people really don't understand. They feel, they separate ESG from the business, but a lot of the funds that are investing in Africa actually have ESG standards. I think most of them use either the World Bank, as you said, or they have their own internal standards that they use. But there was this particular example that I saw, and I think I talked about it earlier, which really resonated with me. It's a private equity fund called Mediterranean Capital, and they invested in a company called BS Invest, which is a retail group out of Morocco. And when they came in, they incorporated, a certain ESG standard, and they were basically part of it from the entire process. So they appointed an ESG officer who was appointed by the PE fund that made the investment. This person reported to the fund, and always, they had like a report that they would come up with, and it was presented to the board. And I think they saw a 17%, job growth, I think after a few years of making that investment. And also when it comes to, hiring women, there was a 9% growth in that. So that takes us back to like a case in point, and how a company that has really enforced their ESG strategy have actually made an improvement. And I think you see a lot of that in the Africa context. We really we look more at the social governance side of things, how we're creating jobs, how more females are getting employed. And I think there are also several different issues here, and I think it would be interesting to also talk about like the sort of trends that you see when you adopt an ESG strategy here, like the BP case, for instance. But I wanted to just talk about the Africa example.
I think we can talk about that in the second version of this panel. I don't think we have time. But I do want to touch on something which I think people in the room will be interested in, is the financial impact of this. You think of it, your first thought, I think, is that it's probably going to be a cost. If you're being environmentally responsible, if you're being socially responsible, and you have good governance, then, isn't that going to cost? Isn't it going to slow down the investment process? Yeah, sure, it's nice, but does it, don't you buy into a company to make money? And is that how you're going to make money? So if I think all three of you could probably address that, maybe with some real examples of where good or bad ESG practices have had an impact, positive or negative, on either profitability of target companies, or ease of exits, or the pool of investors prepared to invest. So maybe Joan, you could dive into that one.
Thank you. So very briefly, kind of along the lines of what Michael was describing, we have a very specific ESG approach. So every borrower company at the time that we are gathering, and I should just put things in context. So we're a fund manager. We invest in small and medium enterprises in select developing economies located in Latin America, Sub-Saharan Africa, and Southeast Asia. So focusing specifically on the African continent, but this is universal across all of our geographies and every single company in our portfolio. So first, we gather documentation for underwriting, and at the same time we are gathering ESG and impact documentation. So these are parallel processes, and they both have to happen, and the company has to pass both sets of screens or they do not get our money. So first things first is, walk the walk with your money and people will follow. We require all of our borrowers to adhere to the IFC exclusion list, another acronym, the International Finance Corporation, which I'm way over. So no alcohol, no firearms, no tobacco. We always question the no alcohol one. The no gambling, no prostitution. Then we apply our proprietary ESG screens, but I will tell you right now that we are open source, happy to share them with whoever would like to see them. And where we're looking for some of those points that I described early on what does the E mean with the S and the G. And all of our borrowers have to attest to those processes. We back it up with making sure, for example, that we look at their employee handbook. We look at their OSHA equivalent infractions reports. We make sure that we understand what this company is doing, how they're doing it, and where there might be risks. We then require them to take one further step, which is they have to self-identify an impact metric, which proves how they're a good stakeholder in their community. Many will pick job creation because they believe that the best thing they're doing is creating dynamism in the communities where they operate, and that gives, putting money in people's pockets gives them agency. But we have many who have picked agricultural productivity and food security because they're in the ag chain, or they pick capacity building because they may not only have great programs for their staff, they may also be educating, for example, smallholder farmers or others in their supply chain.
Can I just ask? I'm interested in this sort of self-declaration part of this.
Yes.
Can I ask what the purpose of that is? You're asking your target companies your
tell
target
us.
investees to identify an impact, an element of
Yes.
what they're doing that has an impact,
Yes.
and then to sort of self-certify that they're doing it.
So they have to provide us baseline data at the time of loan application, and then annually thereafter provide us with updated data. Now, a lot of this is stuff that we can gather from all of ours have to file audited financial statements. So if they're talking about capacity building, we can see how many, how much dollars have they spent on it, and we can get the books to see how many employees did they, educate in a particular year.
But in
We
terms
also
of
do
your
third-party
investment
assurance.
process, what's the purpose of including that?
So the purpose is so that we understand that if they say that they do have good social not everybody does everything, but if they're saying that they are doing capacity building, we need to have proof that they're doing it. We're just not going to believe them. So yes, they self-report, but then we are able to verify through certain books and records.
And does that have any impact on the investment returns? Do you have any sort of noticeable benefit from that?
So going to that, if I can just finish off one thing, for every single company, as they're coming into our portfolio, we do a deep dive on the industry. We find out what are they doing that could potentially have an ESG risk. For example, we invested in a cement clinker in Kenya, particulate matter, noise, water usage. So we make sure that we understand who are the watchdog organizations and the best practices and certifications around that. When it comes down to the profitability, it's I would say at this point, it's really hard to pinpoint and say, well, the fact that they have good capacity building, what that usually means is that our borrower companies actually have high employee retention rates. Could that also be a challenge because we're often operating in regions that have 25% unemployment, so you're not leaving your job, right? Even though it's a crappy job. So there are some things that are more qualitative than quantitative. What I can say is that we're a debt lender, so in 4 years of making loans, and we've actually made about $720 million of loans, we have no loan losses. And you cannot say that it's a one-to-one, causality, but we do believe that picking those good governance companies, making sure that they have the right policies in place, making sure that they are committed to their stakeholders makes for a better business. If you're working with ethical people, chances are they're going to pay you back.
Yeah, that makes sense. So, Michael, can you tell me about one company that you've invested in where good ESG has helped you with an exit, perhaps, and one where you've not entered because of ESG concerns?
Yeah, absolutely. Also, the irony of sitting in front of this slide is not lost on me. Talking about sustainability. So one of the things I always say to each of our investments is that, for a lot of the companies that we invest in, ESG is new, and I always say that the cost of implementing good ESG should never be more than the benefit that it has to the company. And if it is, someone's doing something wrong. So it's super important to consider that that everything that we do in a company, every expenditure of budget, should be with the idea that you're creating value for the company at some point. So we see examples of where good ESG pays back. In a lot of cases, one example as well I'd give is that one of our investments, got from what was not a very good ESG standard to a very good one. They went to expand into a new country, and they were going out for capital, and that access to capital was so much easier because they had all of these things already in place. So a lot of the development banks, the EBRD, the IFC, were looking at investing. Normally that process can take a very, very long time. As if anyone's ever gotten a loan from a development institution, you'll know that that's true. This happened very quickly, because we had everything in place to an international standard. And I think until that point, that portfolio company hadn't recognized what value they were actually creating for themselves until they needed to get external financing from an international investor. So that was a real turning point for them, and also for the partners at my firm who, started seeing, after years of hard work, started seeing this feedback. And again, the comparison I'd make is also at Exit. One of the things I keep trying to say to the portfolio companies when we're looking to implement this stuff is that, when you look to exit, what we should be trying to do is to go to the broadest number of possible buyers, and the broadest number of possible buyers will inherently increase the valuation of your company. You want to be, if you're an African business that is that people wouldn't normally be comfortable investing in, we have to be able to show them why we're a company that international investors should be looking at. Whether or not you're a fund that traditionally or only invests in Africa, one of our portfolio companies should be of an attractive investment for any private equity around the world, because why should that be anything different? We've created a governance structure that's an international level. We've created all of these things. So, if we can sell to the broadest number of investors, then that also creates that creates a very positive story, and we've seen that in the exits we've had recently.
Just on that point though, before you tell me about one that you did not invest in, do you see greater reluctance on the part of investors to put money into African companies because of a misunderstanding or their perception of the risk or the ESG standards?
Yeah, absolutely. I think I have this conversation with a lot of our LPs and a lot of the pension funds. I use a couple of great examples where everyone will be familiar with the idea of bonded labor or slave labor. This is something that is a huge problem in businesses. People often don't recognize that it is. But recently, some of the companies that we've seen in the UK who have branded themselves on being organic, we can talk about this because it was public. There's a company in the UK called Happy Eggs who's branded on being organic free-range eggs, but they had an incidence of bonded labour where people were locked in. They were subcontracting to labour brokers, and they had a lot of issues. This does not just happen in Africa, and in fact, we've seen less of it in our companies because we're so focused on due diligence, looking at those things. It's much rarer for us to find that out afterwards. Whereas in a lot of American and UK companies, people often think that this is regulated for us. They don't have to look that deeply in due diligence, and then they find out, they get these nasty surprises during investment. That doesn't happen to us because we screen those out.
And do you want to just tell us about one company that you maybe chose not to invest in because their ESG was horrible?
I probably can't name any names because there's probably still floating around. We don't have that many. I would say where we haven't invested has been because there have been enormous environmental or social impacts. One of the things that I like to talk to our investment team about is when we're looking at risk, is this a risk to our investment or is this a risk to the society or an environment where that company's working? That's a good distinction to make, because while the risk to the investment is, over a long enough period of time, any kind of impact on the environment or the communities where you work is going to impact your investment, but it's not always an immediate response. So, where we've seen this issue is either been where there's a sort of an enormous governance problem where we won't be able to sort of be invested and then change that quick enough for us to be comfortable. But most of the time it's where we've seen a huge environmental or social impact where we just don't think it's manageable, or the cost, because everything's fixable with enough money. But if you're investing 100 million and I've costed the environmental issue to be 500, then it's not going to work. We've seen that where we've costed out those risks and they've just not, when we've plugged them back into the model, they've just not made financial sense.
Thanks. So we're going to take questions in a couple of minutes. I just wanted to, I've got like five piles of questions here and I've completely lost track of them. Pick a number.
The next
Excellent, Roberta.
we were talking about. So on the transaction advisory side of my business, we also like advise private equity funds on their investment into Africa. And we're looking at one particular investment, which I cannot give like the names or the details of the PE fund or like the investee company, but there was it's in the power sector. So there was this asset that we're looking at, and we're looking at acquiring the assets, two assets, and just converting it into a combined cycle. And there's quite a bit of history, with this, because initially this one of the assets was actually they had raised funds from DFI, so they had gone through like a series of due diligence. And for you to get funding from DFIs, there's just a long list of due diligence things, questionnaires and procedures that you have to pass. So they had done that, and obviously the company had almost reached financial close, and then there was like some issue with politics, and this asset was taken over by the government. And there was a new company that was set up, and that the government set up that was actually managing that specific power plant. So when we were coming in as investors, we had to look at the original, deal arrangements and agreements that were done by the government, the EPC contractors. And this particular private equity fund that I was advising just had so many issues with the history of a transaction, making sure that we really focus on like the technical due diligence, the financial, just going deep into the books. And I was like, okay, first of all, this happened 8 years ago. This asset is currently producing. You want to acquire it. Why can't we just proceed so that we can go to the next stage? And they were like, no, we are being funded by DFIs. We need to have very specific procedures that we follow. Otherwise, we cannot make this investment. So this is exactly the challenge that we face in Africa. You had an asset and an acquisition or like a deal in this space that had such, historically had all of these issues with the government, and they're coming in from the outside as an investor, and they're looking at, the political scenario, and they're looking at it as, high risk investment for them because of what has happened. Even though it's a good value, on the books and everything, they have to make sure that all these due diligence standards are met. So I just wanted to mention that as an example of something that I've been dealing with.
Thank you. So do we have any questions? Over in the corner? Way back in the back corner.
Hi there, my name is Albert Cruz. I'm an MBA Twigo Fellow. I go to Georgetown half the time, the other half the time at the IFC, valuing the equity portfolio. So my question is, have you seen any trends regarding outcomes between ESG outcomes and deal sizes, any regions, sectors, where maybe smaller deals have greater outcomes versus larger deals having maybe smaller outcomes but better financial outcomes? So any trends are by deal size or sectors?
Yeah, maybe I can't answer that in an intelligent way, but I would say that we are about 65% invested in our fund too, and I think, without going into too much detail, I think the ticket size has gone up. So I think the last two investments we made were around $100 million US. Those deals are increasingly difficult to find without having solid ESG stuff in place. You would be very hard pushed to be able to convince someone to spend $200 million on a business that you were not comfortable with their governance structure. One of these companies we recently invested in had a very basic kind of governance system. One of the things we understand is that in order to exit that business, we will not be able to exit that business if we don't have a very solid functioning board of directors and a structure of governance. So in the smaller companies, you can get away with it. Smaller companies that you've got a lot of visibility over, what's going on in the business, and people are a lot more comfortable to buy businesses where there's poorer performance on ESG, much less likely to do that with bigger ones. And so as we go through the cycle of increasing private equity investment into Africa, you could feasibly get through the first cycle we've invested in businesses from a private equity where the ESG performance has not been great. No one's going to buy it from us if that's the same situation. So I think we will see that increasingly. And as people are becoming more inventive about finding those businesses, family-run businesses that they've found the potential in, you're going to find fewer and fewer, $100 to $200 million family-run businesses where you're not going to, where people are going to be tolerant of investing without that in place. So.
Which is good. That makes me feel optimistic for the planet. Other questions, gentlemen at the back.
Hi, I'm Sunil Benimadu and I'm from the Stock Exchange of Mauritius. There's been a number of initiatives to create impact stock exchanges around the world, trying to showcase those companies that are at the forefront of the impact space and the ESG space, but none of those have succeeded so far. So any idea why it is very difficult to create successful platforms for impact companies to list and become public companies? Because based on the feedback that we've received, it seems that there is appetite from the issuer's side, but not much from the investor's side, because I won't say investors don't trust those companies, but they are careful in terms of the ability of these companies to achieve sustainable growth over a period of time, which is the typical kind of reaction that investors would have for companies that are public and are listed and traded on public platforms.
Okay. I must admit, I'm not familiar with any stock exchanges that are focused on impact companies. I think that's very interesting. There's one in London that's specifically focused on impact. Okay. I need to research this.
Just to add, we were approached by some promoters of this space, whether Mauritius would be willing, and the Stock Exchange of Mauritius would be willing to create an impact board. So we were interested with the idea because we thought that exchanges are there not only to promote companies that are very high growth companies, but to also promote companies that are championing the cause of triple bottom line. So we created the rules, but then when it was about going to the issuers and trying to match the issuers with the investors, we had a lot of problems with the investor side of things. Everybody told us this is a great idea, but then when it came to putting the money in those companies, there was not a lot of champions there. So then we dropped the idea. So I wanted to understand from you what are some of the inhibitions and bottlenecks to that.
Sure. I mean, it sounds like a great idea, so it's, I'll be interested to hear what the panel feels.
I think some of the challenges are that in impact investing, this goes back to that sense like there's going to be a haircut if I invest in a impact company. The flip side is an investment has to be an investment first and foremost. So whether you're doing really great things, the fact that you stick a label on yourself is not going to get you investors automatically. And so I think most investors look at, again, this splits out impact versus ESG. So just speaking specifically about ESG, there are, I'm losing count, hundreds of indices that measure ESG. I mentioned the MSCI World Governance Quality Index. So you don't have to have a specific stock exchange to be able to identify companies and have them in an index where you can be comparing them to their peers, because what it's all about ultimately is relative performance. And I think those have been some of those.
Is it possible that the impact focus actually put off investors, that they just...
I think there's still very much a reaction about that this is going to have to be, it's going to be a bespoke strategy, and so there's going to be probably early stage patient capital, probably being equity, uncertain returns, and potentially uncertain exits, because even though they may go public, there may be certain constraints around when those shares can be sold.